Hello everyone, and thank you for joining us in Conversation, the second in this Credabl webinar series. My name is Ed and I'm part of the team at Credabl and will be your host today. Who are Credabl? Well, we are independent financiers to medical professionals. As individuals, we've been in this market for many years, but as a brand, about 3 years. So if you have personal or commercial finance requirements, then please do get in touch. So we set up this webinar series to create a conversation about all the things that are on your mind today. I've been working from home for well over 5 weeks now, and it's certainly been different, even challenging at times. I've even put on a pair of shoes today. But we at Credabl have really embraced this new way of working and have been doing all that we can to be there for our clients. In this 45-minute session, we've invited members of the Credabl team to give some insight into an industry that is going through some really dramatic change, the residential loan market. Before we get into it all, I just want to remind the first timers that this is a conversation, and to those returning friends of Credabl, hello again. So we want to hear from you and would love to answer your questions and concerns via Q&A in the second half of this session. And here is how. On the right-hand side of your screen, you'll see the live event Q&A section, where I'll be able to view all of your comments and questions. So please populate that section with your name and all that you'd like to say. If that live event Q&A panel is not open already, then you'll see a couple of speech bubbles with a little question mark. Just click that button and you'll be right in the conversation. For any mobile Android users out there, you may find a slight audio delay when you type into that Q&A section, but that audio will return. So send through your questions at any time during the session and we'll put the Credabl team on the spot with a Q&A a little bit later on. Okay, let me just make sure that's all working well. Yep. Yes, Josh, this is the first time I've worn a shirt in well over a month. Thanks for the message. That'll do, thank you. Okay, let's get going then. First up will be Lewis Johns, all the way from Scotland, but based up in Queensland. Lewis will be talking to property ownership and the road ahead. Then we're going to hear from Chrissy Hamilton. Chrissy has been writing home loans for medical professionals for many years now, so it's certainly worth a listen when she's talking about the right time to buy or invest. And finally, Credabl's Nick Tagg. Nick is a fan favourite and will be providing us with wisdom on how COVID-19 has been reshaping the real estate landscape. Virtual auctions, are they even a thing? I guess we'll soon find out. And once the team are finished, I will be back to moderate that Q&A. So please keep those conversations coming in using the live event panel on the right-hand side. So without further ado, we're off up to Brisbane where Lewis is ready to speak. Over to you, mate.
Thanks, Ed, and welcome to everybody who's watching. So it was only 2 weeks ago that we hosted our first webinar, and that was very much focused on the road to recovery for many medical practices. And it really highlighted to us that this economic downturn as a result of the pandemic has affected the medical community like no other that's come before. So the last big downturn we saw was, of course, the GFC in 2008 and 2009. And Australia in general was relatively unaffected by this in comparison to the rest of the world. And then our client base, which are doctors, dentists and vets, also weren't too badly affected during this. In actual fact, it gave a lot of our clients an opportunity to invest because they still had a stable income and they were able to take advantage of moving into this new low interest rate environment. So this time around, it's clearly different because of the restrictions that have been placed on a wide number of businesses, and the medical community have not been as well insulated as in the past. Now, from talking to our clients, what we've seen is that dentists and surgeons have actually been some of the most worst affected of all of the clients that we deal with. The reason being, for dentists, they had to go on to a level 3 restriction where they were only able to treat emergency pain patients. And for a lot of practices, this was not commercially viable and they actually had to close the doors. Then for a lot of our surgeons who again have very robust business models and who are people who are extremely well qualified, they also had to close their businesses because the government placed the restriction on elective surgeries. Now, thankfully, on the same day as our webinar 2 weeks ago, we had 2 pieces of really good news emerging, which were the government lifting the restrictions on elective surgeries and also the Australian Dental Association dropping the restrictions on dental practices from a level 3 restriction down to a level 2, which has enabled a lot of our dental clients to carry out a lot more procedures rather than just the emergency treatments. So there has been some good news, and we do hope that there is more to come in the coming days and weeks as things do seem to be moving quite quickly. From speaking to a number of our other clients, we also still do have a lot of people who are doing okay, and some who are actually doing quite well. So I've spoken to some GPs who have said that their practices are actually busier than ever because everyone is taking some additional precautions with their own healthcare. I've spoken to doctors in the emergency departments, and from what they're telling me, things are mostly under control, and we haven't seen the huge spike in cases and the big burden on the hospital system that some people were predicting. So it's really good to hear that all of the social distancing measures that we are carrying out are actually working so far. And then not to forget our veterinary clients. So speaking to a number of vets, they really haven't been too affected by any government restrictions placed on their practices. So most of them are reporting that it's mainly business as usual, which again is great to hear. So definitely this time now, compared to a month ago, we're seeing a lot more positivity, and we're moving away from the initial panic that everybody had when this crisis first hit, and now everybody's started to look at the task in hand, and the narrative has changed so that we're slowly looking to reopen the economy on a step-by-step basis, whilst of course keeping everybody safe and making sure that we do adhere to the restrictions around social distancing. So what that means for our clients is that it's now time to be thinking about what your financial future looks like and how to put yourself in the strongest financial position going forward. Now, one thing I wanted to touch on briefly is just the amount of attention and emphasis that the media has actually been placing on deferring your mortgage payments, and it's actually something that I saw again in the news last night. Lots of different language has been used around this, as to taking payment holidays or freezing mortgages, and there's even been talk of switching some existing principal and interest loans to interest only. Now, just to emphasise that these are all definitely options that are available to you, but we do feel quite strongly that they should only really be used as a last resort. Now, the reason for this, and something that's not been given the same level of attention by the media, are just the financial implications and the cost involved with actually deferring your mortgage payments. Now, what happens during this period of time is, if you take a 3 or a 6 month payment holiday, depending on which financial institution you're with, then the bank continues to charge you interest during this period of time. Now, because you're not actually making any payments to your mortgage, the interest is simply added back into the loan, and then the following month you're charged interest on the higher loan balance, and then the same thing happens the next month. Now, over a period of 6 months, this actually has a compounding effect. And the end result of this is that depending on the overall amount of debt that you have and how many years you have left remaining on your mortgage, it can cost you thousands of dollars of interest over the life of the loan. And looking at, say, let's just say a modest mortgage of $500,000 with 20 years to go, if you were to defer your payments for 6 months, it might cost you a few $1,000s extra. Now, if you are somebody who perhaps has a more expensive property with a larger mortgage, maybe even picked up a couple of investment properties because the market's been doing really well in the last few years, then taking a 6 month payment holiday across your portfolio could actually cost you tens of thousands in additional interest. So really, unless you are in a situation where you've exhausted all options and there's nothing else that you can do, then we would advise you to have a look at what else is going to be possible for you. And part of that reason is it's only a very short-term solution to actually defer your payments, because it will go for, as I said, 3 to 6 months, depending on the bank or mortgage provider that you're with. Now, after that period ends, you're going to be left with either a higher ongoing mortgage repayment when you switch back to principal and interest, or you may be able to negotiate with your bank to continue on the same repayments, but you're going to have an extra 6 months added to the life of the loan. So either way, it's going to cost you more in the long run. And considering that most clients will initially take out a mortgage over 30 years, it's definitely a long-term commitment, and you want to be looking at the longer picture and the bigger picture rather than just focusing on the next 6 months. So unfortunately, we are in a period of economic contraction, and whether we like it or not, it does look like the economy is going backwards for the time being. So the last thing that you want to be doing at a time like this is taking on any unnecessary additional costs. What you should really be doing is looking to see how you can save money across all areas of your household budget. Of course, the biggest ticket item within your household budget is more than likely going to be your mortgage. So looking at ways that you can actually reduce the cost of your mortgage over the full 10, 20 or 30 years, however long you happen to have remaining. And up next after me, Chrissy is actually going to talk a little bit more about some of the options available for refinancing. So going back to some of the good news that we've had so far, I think the government, regardless of all of our opinions on various politicians, have done a fantastic job of reacting to this and trying to keep everyone as safe as possible whilst stimulating and propping up the economy. And looking at the statistics, we really are miles ahead of the rest of the world, along with our friends over in New Zealand, who are also doing a great job. So we've got increased financial support available to households, which is definitely having a direct impact on the housing market. So the two big government pieces of stimulus are the new JobKeeper scheme and the increased payments for the JobKeeper scheme. So that the reason that they're positively affecting the housing market is that anybody who has taken a hit on their income now has cash flow coming in, which hopefully should allow them to continue paying their mortgage and not being in a position where they have to go out and sell. Now, it's equally as important for all of our property investors as well, because this cash, if it's given to their tenants, allows their tenants to continue paying their rent, and in turn it means that you have cash flow coming in to continue to meet your mortgage commitments on your investment properties. So those are two really good pieces of government stimulus which are helping us out so far, and because of this we haven't seen a lot of owners forced to sell their property, which is something that really would impact the market, and we think we would bring prices down. So what we're all hoping is that these measures for the time being are going to be enough to allow people to get through the shutdown period, emerge on the other side relatively unscathed, and then be able to get back to work. Then another huge boost for property owners are the recent Reserve Bank rate cuts, which have brought the base rate down to 0.5% and then again down to 0.25%. Now, although the banks generally don't actually borrow money directly from the Reserve Bank, it does act as more of a benchmark. So when the Reserve Bank reduces interest rates, most of the banks to an extent will follow suit and also drop their rates. So it's definitely worthwhile, if you haven't done so already, checking in with your bank, finding out how much of the recent cuts and how much of a saving that they've passed on. But effectively what it now means is that interest rates are at rock bottom or at very close to it. And drawing on a bit of my own personal experience, I was a mortgage advisor in the UK after the 2009 financial crisis hit, the GFC. Now, at that point in time, the Bank of England did almost exactly the same as what the Reserve Bank of Australia is doing now. They cut the base rate down to 0.5% and then again cut it down to 0.25%. So what we're actually seeing now in Australia, whilst that might be a first here, we have seen it happen in other countries. And just having a look at what happened to interest rates in the UK at that point in time, when they came down to this level, the interest rates being offered were roughly in line with what we're now actually seeing in the Australian market. So as far as we know, we do think that rates are probably as low as they're likely to go. However, the Reserve Bank, when they cut rates, does make a bit of an announcement as to what they think is going to happen going forward. They said they don't want to cut it down to a cash rate of 0, but we never know exactly what's going to happen. What we have seen this week specifically is that all of the major banks have come out and announced that their profits are actually being reduced dramatically. So there really isn't an awful lot of margin left for the banks to actually reduce rates further, even if we did see a reduction in interest rates by the Reserve Bank. But it's an unprecedented time, so we never know exactly what's going to happen. So the big banks taking a hit on their profits, of course that's bad news for the stock market, it is bad news for all of our super funds, but it is good news for property owners and for first-time buyers, as home loans are now cheaper than ever for both owner-occupiers and investors. So again, this low interest rate environment that we're seeing, it is a deliberate action by the government to try and provide some relief to people's cash flows, but also to provide a bit of a bottom to the housing market and stop it from having this big crash that some people have been speculating on. Because of all the government stimulus, we haven't actually seen the market crash, as some people have been predicting. And for both the March and April months, there were a very, very marginal increase in house prices across most of the capital cities. So compared to a month ago, we are seeing a lot more good news. But the road ahead is obviously very uncertain, and we don't know what the long-term effects of the shutdown period are going to be, how long it's going to take for the economy to recover afterwards, and bring down those all-important unemployment figures. So really, I would say that whilst we did have some initial panic in the last month, we were telling our clients just to stay calm and work through this period, and to some extent that message hasn't changed. We have now had some good news stories. It does look like we are starting to get on top of things and move in the right direction, but of course we will see a lot of challenges and uncertainty going forward. So the key message from myself and from everyone at Credabl is that we are definitely here to help guide you through anything that you need help with financially, whether that's your own mortgage or whether you're looking at buying your first property. If you need any emotional assistance, you might be struggling with the stress of running your business or making your loan repayments, whatever it might be, please just feel free to pick up the phone, have a chat to any one of us. We do have a really experienced team here, and all of our mobile numbers are online for that reason. But that's all for me for now, and a little bit later we will chat about the impact of COVID-19 on the market and how we have all had to adapt to this new way of working. And I'll pass back over to Ed to introduce our next speaker.
Thank you, Lewis. Certainly sounds like there's a fair amount to consider out there. So Lewis will be around later for that Q&A, so if you do have any questions for him, please do use that panel on the side. So now on to what I'm sure is a big question that our audience will be asking. When is the right time to buy or invest? Chrissy, bit of a tough one for you.
Hi everyone, thanks Ed. Well, I guess given the low rates in the market, rental payments are very similar, if not the same as loan payments. To be honest, I've seen owner-occupied variable rates as low as 2.69 with fixed from 2.19. Look, there is a definite softening of the property prices in the market, which Nick's going to speak more about later. Recently, I've actually had a lot of interest from clients asking for pre-approvals to purchase an owner-occupied home. They feel the property market is at an all-time low. One thing to consider, however, is the turnaround times to obtain an approval. Due to COVID, approvals are taking between 2 to 5 weeks. It's important to ask the lender what their current turnaround times are. You really don't want to miss out on an opportunity to buy that perfect property. One other thing to note, some banks are also asking for more paperwork from COVID affected industries. I've actually had a few of my clients who have had to provide extra paperwork depending on where and what industry they work in. People in the dental space need to provide 9 months BAS along with 3 months bank statements for their practice, and their practice must be open. So a little while there, a few dental practices did shut down at that time, and unfortunately credit weren't looking at lending to those particular clients. However, now obviously the restrictions have been lifted a little bit, so it's a little bit easier now to provide that stuff. In the medical and vet space, you haven't actually been deemed as COVID affected, but some lenders are asking for explanations on how you're personally not affected and can comfortably afford your loan payments during this time. As an example, they want to know if you're still working, if you're operating full time, and you will continue to work at your maximum capacity. And sometimes they've asked if you've got some savings to get you through. One thing I'd also like to touch on is the loan to value ratios with lenders' mortgage insurance during COVID. 2 of the major lenders have actually dropped their max no LMI LVR to 85% regardless of your industry. This has actually been put in place for the next 6 months, Ed.
Very interesting, Chrissy. And why don't you talk a little bit about refinancing? I know that was something that you've covered in the past.
I have. For myself, refinances actually make up the majority of queries I'm receiving at the moment. I guess, look, clients are looking for better rates, or they just want to restructure their debts for better repayment terms. I've also had a few clients looking to release equity to take advantage of the lower stock prices. So they're looking to invest in shares, or they're actually getting something out to help with cash flow, whether it's for the practice during this time. Many of the lenders are still offering a refinance rebate, so it's actually a really good time to review your home loan. Refinance rebates can be anywhere from like $1,000 up to, I've seen some, they're up to $4,000. Not sure if that's still available. We can always check for you. I will say, however, if you do want to refinance, it's a good idea to get a valuation done sooner rather than later. There is a risk that prices may go down and then you're kind of stuck with your current bank. Back to you, Ed.
Thank you, Chrissy. So remember to keep those questions coming in, everyone. We've got the panel on the right-hand side there. But before we do get to them, and there are some good ones there already, so thank you, let's bring to the screen Mr. Nick Tagg. Good afternoon, Nico.
Good afternoon, Ed. Good afternoon, everybody. Thanks for joining. COVID-19 has affected every industry, and Australia's love affair of property and all things real estate is no exception. You might be thinking, can I still buy and sell my house? And the answer is, of course, yes. But the way things are happening now are very different. Now, if you've been getting outside for your daily allotted exercise time and notice that open houses have still been going on, before you go and dob them into ScoMo, they're still allowed to do this for individuals on an appointment case-by-case scenario. But as far as other face-to-face meetings go, that's kind of where it stops. Like all businesses, the real estate market has had to embrace connecting people digitally. So what we're seeing now is we're seeing new ways of how we can go into open homes. And if anyone's been onto realestate.com or Domain, what's taking place now is a lot of virtual tours and virtual online and open homes. I've been onto the websites a few times and I think they work really, really well. An agent will go in there, take a live video of the home or unit you're looking at, and throughout there, he sort of makes some commentary around it. So it's a really good tool that they're adjusting to as well, and allows people to still look and engage with agents and auctions and upcoming property that they're looking to buy. It has also in turn reshaped the way auctions are conducted. I mean, people love to talk about auctions and like to talk about clearance rates, and what's happened with auctions now is they too have gone online. So obviously with the restrictions on how many people we can have in a crowd and social distancing, they had to pull those back. And look, people are sort of taking to them, but let's have a look. And I thought it'd be a really good idea to kind of look at where are some of these auction clearance rates in what's happening with COVID, as opposed to a time last year. So I took some data from, I'm going to go back to Saturday, the 18th of April, and can compare that with Saturday, the 30th of November last year. Now, a little bit of a different market. I know that's coming out of spring and into summer, and it's starting to heat up there, but it's interesting to look at the numbers. So if we look back on Saturday, the 18th of April, in New South Wales, we had 691 auctions with a clearance rate of 34%. Victoria, we had 833 auctions with a clearance rate of 30%. And in Brisbane, we had 67 auctions. Lewis, maybe you can shed some light into the auctions up there. It doesn't seem that many, but they had a clearance rate of 22%. And if we look at what happened last time with this sort of similar weekend, in New South Wales, we had 889 auctions with a clearance rate of 81%. And in Victoria, we had 1,331 auctions with a clearance rate of 76%. And in Brisbane, we had 88 auctions with a clearance rate of 57%. So when people talk about clearance rates, generally speaking, the higher the clearance rate, the percentage, the more buoyant the market is. And then traditionally speaking, the lower the clearance rate, the softer the market is. And so one would kind of look at that data and kind of assume that, hey, the property market's really kind of collapsing. And whilst we're seeing that data on the auction clearance rates, it's not necessarily translating into huge property prices coming down, as Lewis kind of alluded to. Like, there are definitely still some bargains out there, which we're seeing, and clients like Chrissy's clients are looking at kind of taking those up. But as a whole, we're not seeing the big slump in the property prices. So what I think we're seeing, and just talking to agents in and around the area, is we're looking at more private treaties going on. And reading a couple of articles, we're kind of suggesting that we might be going into like a holding phase, and a holding phase for both parties, a holding phase for buyers and a holding phase for sellers. A lot of the stimulus packages that Lewis kind of referred to earlier, it does, I guess, if people are in a little bit of trouble, it puts them on, that potentially can pause themselves for that 3 to 6 month period. And therefore it allows them to regroup, look at source other employment, and still get that government assistance. So the flood of properties onto the market that potentially we might have traditionally seen in a crisis, it isn't coming into the fold just at the moment. So I guess what we do need to just wait and see is what the market's going to look like in the 3 to 6 months time. One of the big precursors, I guess, is the unemployment rate, and it gets, when that goes to kind of 10%, kind of gets a little bit scary. And also what's going to happen when the government assistance kind of dries up and everyone kind of has to, I guess, fend for themselves. So clearance rates are a little bit down, but not necessarily meaning that the property prices are at the moment going down with them. So there's been also a couple of changes in the banking world as well out of COVID, and there's been some bad changes, but there's been some really good changes as well. One of the major changes we've seen is that banks are more now, accepting of desktop valuations. So I guess when you buy a property, whether you buy a property or whether you refinance, like the knee jerk that a lender will trigger is a valuation, and 9 times out of 10 that involves a physical person coming into your house, taking a couple of photos, and then putting together his or her report. With the social distancing rules, and I guess people potentially not wanting valuers, strangers into their home, banks have then adopted the need and the ability to use these desktop valuations a little bit more. And so what they do is they just basically pull data around and then generate the report without the need for someone to go in and inspect it. So that's a really good thing that the banks have rolled out. And in addition to that, on those desktop valuations, they're also allowing higher loan to value ratio lends that potentially, historically weren't. So on top of the desktops, we're also seeing some higher loan to value ratios on the desktops. Another great thing that's come out of it all is obviously at Credabl, we like to see all of our clients, and that's why our clients love dealing with us. It's a little bit hard to at the moment, and we can't wait to get back out and see everybody because that's what we love doing. But we still need to verify people's ID, okay? And so one of the big changes that came out quite quickly, which was nice, was the ability to banks to allow us to kind of verify people online. And so we collect information, and then through videos such as like this, what we're doing today, we can go through a process of verifying you online. And so there's some nice changes, Ed. That's pretty interesting. What do you think?
Thank you, Nico. You certainly promised me some more golf memorabilia on the shelf behind you, but we'll go with it for now. Well, I've still got you, mate. You and I chatted last week about the conversations you've been having with your clients around valuations, and you touched on it there. Have you got a little bit more on that for us?
Yeah, I do, Ed. Thanks for that. It's a good one. I mean, obviously, when anyone financing, there is a need to do that, to do those valuations. And when valuers are going out at the moment, they are a little bit more on the conservative side, obviously, with what's going on. And there's a couple of things that they're doing to kind of, soften these valuations. First of all, we're seeing a lot more higher risk ratings. And for anybody who's seen a valuation report, which is an interesting read, but what they do is they rate the property with about, from about 8 or 9 segments. And then within those 8 or 9 segments, they then rate them between kind of 1 to 5, 1 being great, 5 being not so great. And at the moment with COVID, we're seeing a lot more ratings of 4 different categories. And with that comes, I guess, higher scrutiny with banks when we see lots of multiple higher risk ratings, which isn't great, and we just have to navigate that as lenders. And then 2, obviously with the market sentiment, valuers are being slightly conservative, we're seeing with their valuation figures. And so it's a really good time, I guess, now, before we see a slump in property prices, potential slump, that if people are looking at refinancing, that now's a really good time to kind of do that before potential prices do fall. And that way you can lock in those lower rates that Chrissy was mentioning, and then also you're not then kind of squeezed out if your property price is kind of valued a little bit lower. But it's really good to stay on top of things. And it's really, really important that if you are looking at buying, to touch base with your lender, to have a chat and make sure that you get that pre-approval in, because as Chrissy was kind of mentioning, and Lewis, the market is changing and evolving daily. At the moment, it's more good news than it was kind of 2 or 3 weeks ago, but it's still evolving daily. And even if you were approved kind of 2 or 3 months ago, it's really important to check in with us. We're always here and available to make sure that that is still a great approval and a great option. And vice versa, if you're kind of looking into getting into the market, it's really important that you get your approvals done now, and then you take the finance off, because it is a little bit of a changing market, and it's really important that you get your approval now. I might pass it back to you, Ed, now, as I hear and can see on the side that we've got a lot of questions, which is fantastic. So over to you.
Indeed we do, Nick. So just to remind you all that right-hand side of your screen is the live event Q&A section where we are working through all of your comments and questions. So thank you for those. So now to put those questions to the team and we'll get straight into it. The first one I'm actually going to throw to Chrissy, give Nick a breather. Chrissy, what are the Credabl Squad turnaround times?
I definitely thought I was going to get this question. At the moment, for our own internal home loan, I've actually been getting some really good turnaround times from our credit because we do it internally. Our head office is in Sydney. So I've had credit look at applications between, to be honest, like 4 business days to maybe a week and a half and no longer. So it's actually been very, very off-balance home loan. It depends what lender you go with. So things, I won't say what banks, but I do have one client that is at a major that I've been looking to refinance for a while, and I pushed it along as much as I could, and that was up to 5 weeks. So internal home loan, much faster because we can push it from our ends. We don't really have that much push when we're going off balance, but 2 of the lenders we actually do have a really good relationship with, and if there's something that urgent that needs to be done, we actually do have really good contacts there as well. So hopefully that helps.
Thank you, Chrissy. So another one we're working through here. Nico, put your glasses back on. Is there any way to improve your equity release if things are done via desktop valuation?
Well, well, obviously, if you are looking at doing a refinance, to look at extracting some cash for whatever reason, whether it's to invest into the share market or to maybe free up some cash to put as your deposit for your next property, then in theory, it's a really, really great time, whether it is through a desktop valuation or through a normal valuation. That's something that I guess we could decide on a case-by-case scenario, depending on which lender you go. But it's certainly a really easy process to do, to look at, accessing some cash that's tied up in your property to do whatever it is you really want to do. So it's a good question. It's certainly, yes, we can something we can do, and we'd love to help you out if that's what you'd like to do.
Thank you, Nico. So some good ones coming through now. I've got a handful. Lewis, how do I know which bank to go with? Good question.
Thanks, Ed. Now, that is a fairly interesting question. I wouldn't really get too hung up on dealing with any one specific bank. I know a lot of people might have had a bank account with somebody for a long time, or maybe their parents always bank with someone, or your friends or work colleagues did. But everybody's circumstances are different, so that there isn't really a one-size-fits-all approach, and there isn't one bank that's better than everybody else, because we've got many financial institutions within Australia, and there's a real good spread between them as to who people use. What I generally say is more important is the person that you sit down and speak to. Most of the time, if someone has a really good experience with a bank, it's because they had a really good banker that was actually looking after them. And it's got more to do with understanding your personal finances, understanding what it is that you need with your mortgage, and trying to find you the right deal. But as well as trying to find you the right deal, we need to make sure that we can actually get your mortgage approved, because whilst all banks operate within the same rules and regulations, they do have slightly different lending criteria, and we need to look at a few different options to make sure we fit you in the right place. We might have a self-employed dentist, for example, who has a practice and is opening a second location and taking on a few extra business debts. And that's a completely different risk profile to, say, a salaried Queensland Health doctor. So for a self-employed dentist, we need to take some time to understand your business model, understand how you generate an income, and make sure that we're happy with that risk, and we know exactly where to place you. Whereas with a salaried Queensland Health doctor, you might have a much more straightforward financial position where you have your salary coming in and you have very little outgoings, and every bank in Australia is going to love to deal with you. So we'll have a range of options, and we can make sure that we do focus more on just finding the right deal that ties in with your needs. But yeah, interesting question. Thanks, Ed.
Very well answered, may I say. Next one's come in from an anonymous viewer. I'm going to send this one to Chrissy. Should I choose fixed or variable rates?
This is an age-old question and one I receive a lot. I guess, look, many of us want to take advantage of the all-time low fixed rates right now, but 99% of the banks only provide an offset account and a variable rate. So what do we do? I say if clients are looking to fix for 2 to 3 years, I ask them how much they think they're going to save during this period. And that is the portion of the loan that they should think about leaving variable, because you can only offset what you can save. So if you're going to only save a little bit, then potentially fix more. It's completely up to you. For the lender that does allow an offset on a fixed rate, you have the option to fix the entire lot. That's really it, Ed.
Very good, thank you. I can see Lewis gesturing to me. Have you got something to add to that one?
Yeah, definitely. Look, Chrissy, definitely the most important thing is finding if whether or not fixed or variable is ties in better to your needs. For the people that are out there just chasing after the lowest interest rate available, just looking at where fixed is versus variable just now, and the rates that Chrissy mentioned, 2.19 as a fixed rate versus 2.69 as a variable rate. So we have a difference of 0.5%. Now, in relation to the Reserve Bank, which is sitting at 0.25%, in the unlikely event that they do cut to zero, and in the even more unlikely event that your bank passes on the full 0.25% on that variable rate, that still only brings you down to 2.44%, if my maths are right, which is still 0.25% higher than where the current fixed rates are just now. So really, we do think that the fixed rates that are being offered just now are as close to rock bottom as we're going to get. And as long as Chrissy says, you're happy that fixed is more suitable to your needs than variable, that's definitely where we are seeing the cheapest rates at the moment. Thanks, Ed.
Thank you very much. Another one that's come in here, and I'm going to send this one to you, Nick. Are desktop valuations usually more or less conservative when compared to an on-site valuation?
It's a really good one there. Thanks for the question. I'll answer it in two parts. I mean, like if you look at the overall on-site valuations, better or worse than desktop valuations, you know, generally speaking, I think we would see that the full valuation is a better valuation. It's more comprehensive, and you know, more often than not, you do get a better valuation. Having said that, I'll answer it another way, because I had the same scenario happen to me with a client literally last week. We were looking at doing a refinance and a purchase for him, and we did a full valuation on his existing unit, and it came in at, I think it came in at 600 and 610,000. The purchase that he was looking at the time didn't go ahead, and then through circumstances that happened, we decided to look at another option for him, which triggered a desktop valuation on the same unit. And the desktop valuation actually came in $100,000 more. So to probably answer the question, it's really sometimes a little bit of hit and miss. I mean, there's no, I can't sit here and certainly say that, you know, a full valuation is better or a desktop valuation is better if we're just looking for the dollar amount most we get out of a valuation. I think historically we'd look at desktop valuations probably being a little bit more conservative, just given it's pulling data as opposed to a person going out there and looking at it. But in the case I've just recently had, it was the other way around. So it can go both ways, and I hope that answers your question. But if you've got a property we'd like to look at, more than happy to take it offline and we can discuss further. Thanks, Ed.
Thank you, Nico. I've got another one here that actually has been a topic of conversation recently. I'm going to send to you, Chrissy. Can I refinance if I defer my repayments?
This is a question on so many lips right now. Look, although the banks have said that they will not list a default on your credit check or your loan, there is a bit of a grey area as to what happens after that. Responsible lending states you must show good loan repayment conduct in order to refinance your loan. If you're deferring your payments, you're effectively not able to satisfy this condition or this requirement. To be honest, the best thing to do is speak to the lender you're looking to refinance and ask them how many months of repayments to your home loan you need to show before you can make the move to them. That's really all you have to do. Thanks, Ed.
Thank you very much. We've got a couple more to get through here. We're conscious of time. This one is for Lewis, I think. How hard is it to switch banks?
Thanks, Ed. It really shouldn't be hard to switch banks, but sometimes, depending on who you speak to, people do find it hard. The process is relatively straightforward. So we have a look at your finances, approve your loan, do a valuation on your property, and then our solicitor contacts your bank to get some payout figures. So the process itself should be relatively straightforward, but again, it really just boils down to the actual person that you're speaking to, and whether they have an in-depth understanding of your personal finances, whether they actually take the time to get to know you and understand your needs and understand how your business actually generates income. So I would urge any medical professionals to make sure you do speak to somebody who's really involved with the industry and knows what they're talking about, because that can make all the difference in that first step of the process from making the loan approval. Could be really hard, or if you talk to the right person, then it could be really easy, which is the way it should be. Thanks.
Thank you, mate. So we've probably got another couple of minutes to go if you want to put some more questions in there. Well, I'll just wait for those to come in. I'm going to throw a surprise one to Nick Tagg. Nick, I went for a walk the other day because there's not much else to do, and I thought I saw a lot of real estate boards with sold splashed across them. Now, that suggests to me that this particular area is going well. There's a lot of sales happening. Is that something that I just happen to have noticed, or do you think that's something that the country is going through?
Yeah, thanks, Ed. Well, I hope you're only going out once a day at the moment. It's not multiple outdoor activities. You know what? I've noticed the same thing too. I mean, I guess we're in similar areas demographic-wise, and walking down the street, I do see a lot of sold signs still out and about. There is still property turning over, so people are still buying and selling properties. I've got a lot of clients that are still buying, which is really great. Maybe but also, Ed, to be front, you got to be there front of mind to get the next deal. So maybe agents are just leaving those signs out on the road a week or two, maybe longer than they need to. But certainly it's still a very active market. You're over in the east, I'm over in the north, so I'm seeing a lot of signs out there too. But property market is still moving along, and like I said, we're still seeing some quite positive sale results coming through. So thank you for that, Ed.
And very well answered, my friend. So I think that's about it, to be honest, with the questions. So I'm probably going to wrap up now. We've almost reached our 45 minutes, but thank you all for those questions. And I'm sorry if we didn't get to all of your sort of suggestions and questions as we went through. But if you have any more, we will be holding another in conversation in the next couple of weeks. So do keep an eye out for that. But if you do have any topics you didn't quite get into there and you'd like us to cover, please leave a message in the live Q&A now or contact us directly via the website. We do have a live chat option on the website, which we monitor almost 24 hours a day. We do need some sleep, or simply email us via hello@credabl.com.au. So thank you to Lewis, Chrissy and Nick for their insights today. And thank you all so much for taking the time to join us. We hope you enjoyed the conversation and are maybe feeling a little bit more positive in these uncertain times, but that's certainly enough from me. So on behalf of the whole Credabl squad, stay healthy and we'll see you soon.